Welcome to the video. Today we will cut through the noise and help you decide whether you need a professional advisor or if a do-it-yourself approach is enough right now. We will clarify the difference between a CPA and a financial advisor, explain when to hire and when to save your money, and show you how to focus on high-impact basics first. Let's begin. First, we will outline why many people in their early 30s do not need to pay for professional advice yet. Next, we will compare CPA and financial advisor roles. Then, we will give you a practical DIY starter plan. After that, we will explain how to find and vet a fee-only fiduciary. We will follow with a simple explanation of tax-integrated planning. Then, we will clarify when it finally makes sense to hire someone. Finally, we will test your understanding with quick quizzes. Before we go further, this content is educational and not personalized financial, legal, or tax advice. Please consult a qualified professional for guidance tailored to your situation. Now let us move into the core distinctions that will simplify your decision-making. To start, here is the reality check. For many people in their early 30s who have a relatively simple financial picture, hiring a professional advisor is usually a luxury rather than a necessity. Therefore, we should focus first on the fundamentals that matter most. With that framing, let us clarify the roles of a CPA and a financial advisor so you can prioritize correctly. Let us break down the split. A CPA focuses on minimizing tax liability and ensuring compliance with the IRS and state. A financial advisor focuses on investment selection, retirement projections, and broader wealth accumulation strategy. It is uncommon for one person to be expert level in both. If your tax situation is straightforward, the best use of your time is to learn and apply basic investing principles first. If you still want expert oversight, prioritize hiring a fee-only fiduciary who does not accept commissions and is legally required to act in your best interest. If you can find someone who integrates tax-aware planning with investment advice, that is even better. On the left, a CPA excels at tax preparation, deductions and credits, compliance, and projecting taxes. They are ideal when returns get complex, such as with business ownership, multi-state income, or special credits. The work is often concentrated around tax season, and the deliverables include filed returns and tax projections. On the right, a financial advisor excels at building an asset allocation, creating retirement models, clarifying savings rates, and guiding investment vehicles. Their work is ongoing throughout the year, with periodic reviews, and the deliverables include portfolio strategy, risk alignment, and goal-based plans. Together, these roles can complement one another, but for many people early on, focusing on investment basics may be sufficient. Here is a quick guide. If you have a single W-2 and use the standard deduction, do it yourself using tax software and focus on basic investing. If you have an employer 401k match, prioritize capturing the full match first because it is essentially a risk-free return. If you hold high-interest debt above roughly 6 to 8%, prioritize paying that down, because the guaranteed savings often beat expected investment returns. If you handle multiple K-1s or own business entities, hire a CPA. If you feel uncertain about portfolio risk or how to rebalance, consider a fee-only fiduciary for a focused checkup. Finally, if you receive a large windfall or inheritance, hire both a fee-only fiduciary and a CPA for coordinated planning. Next, let us cover a practical do-it-yourself plan. First, build a 3 to 6 month emergency fund and park it in a high-yield savings account. Second, eliminate high-interest debt and automate extra payments so you make consistent progress. Third, capture your full employer 401k match, and then consider contributing to a Roth IRA and an HSA if eligible. Fourth, keep your investments simple with a 3-fund portfolio covering total U.S. stocks, international stocks, and total U.S. bonds. Fifth, automate contributions on payday to reduce friction. Sixth, minimize fees using low-cost index funds and ETFs, and be cautious of expense ratios above roughly 20 basis points. Seventh, rebalance once a year, or when allocations deviate by around 5 percentage points to maintain your risk target. Eighth, prioritize tax-advantaged accounts, and then use a taxable brokerage account for additional investing. Ninth, insure against major risks with appropriate term life, disability, health, and property coverage. Finally, review annually and adjust as your income, family situation, and goals change. Now let us visualize how advisors are commonly paid. A large share of the market uses an assets under management percentage, often around 1%. A meaningful and growing segment uses flat fee planning, while some operate hourly. Commission-based products still exist, and those create conflicts of interest, which is why this video recommends avoiding them. The exact percentages shown are conceptual to help you understand the landscape rather than precise market statistics. Moving on, here is how to vet an expert properly. A fee-only fiduciary is legally obligated to act in your best interest and is compensated directly by you without commissions or product incentives. Check for credible designations such as CFP or CPA with a personal financial specialist credential, and look for membership in organizations like NAPFA or the XY Planning Network. Request and read their Form ADV, specifically Part 2A and 2B, to confirm how they are paid and what services they provide. Ask whether they perform tax-integrated planning, such as asset location, tax loss harvesting, and Roth conversions. Be cautious of red flags like product pushing, annuity first sales pitches, and unclear or layered fees. Next, let us define tax-integrated planning. Asset location means placing less tax-efficient assets, like bonds or real estate investment trusts, in tax-advantaged accounts, while placing broad equity index funds in taxable accounts for better tax efficiency. Bracket management involves intentionally filling lower tax brackets with Roth conversions or realizing long-term capital gains. Tax loss harvesting takes advantage of market declines to offset gains and potentially up to $3,000 of ordinary income per year, subject to rules. Withdrawal sequencing aims to preserve tax-advantaged growth and manage future costs such as Medicare-related surcharges. Charitable gifting strategies like bunching deductions, using donor-advised funds, and later qualified charitable distributions can further improve after-tax outcomes. A fee-only fiduciary who integrates tax planning will evaluate both your portfolio and your taxes together and provide coordinated recommendations. Finally, here is a suggested timeline for your 30s. In the first 1 to 2 years, build your emergency fund and eliminate high-interest debt. In years 2 to 3, capture your employer match and open tax-advantaged accounts like a Roth IRA or HSA if eligible. In years 3 to 5, establish your simple 3-fund portfolio, automate, and rebalance annually. In years 5 to 8, begin optimizing taxes with asset location, tax loss harvesting, and possibly Roth conversions when appropriate. After 8 to 10 years, consider hiring a professional when your situation becomes complex, for example due to business ownership, large inheritances, multi-state issues, or high net worth. Question time. If your taxes are simple and your main goal is to start investing for retirement, where should you focus first? Option A, hire a commission-based advisor to pick products. Option B, hire a CPA to manage your portfolio. Option C, learn basic investing and prioritize low-cost index funds. Option D, open a margin account and day trade. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is to learn basic investing and prioritize low-cost index funds. In the early stages, focusing on broad market, low-fee funds and a consistent savings habit provides the highest impact for most people with straightforward finances. Here is the second question. Which type of advisor structure best aligns with your interests and avoids product sales commissions? Option A, commission-based broker. Option B, fee-only fiduciary. Option C, anyone with a fancy title. Option D, the person who promises the highest returns. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is fee-only fiduciary. A fee-only fiduciary is compensated directly by you and is legally obligated to act in your best interest, which reduces conflicts of interest compared to commission-based models. To summarize the key points, most people in their early 30s can handle the basics themselves and should keep their money working for them. A CPA focuses on taxes, while a financial advisor focuses on investments, and it is rare for one professional to be equally expert in both. If you decide to hire, choose a fee-only fiduciary to avoid commission conflicts. For comprehensive advice, look for tax-integrated planning. Finally, reserve professional engagements for when your situation legitimately becomes complex. In closing, start with simple, low-cost investing and automate your savings. Use CPAs for complex tax situations and financial advisors for portfolio strategy. If you insist on help, make sure the person is a fee-only fiduciary and ask specifically for tax-integrated planning. Only upgrade to professional help when your life circumstances justify it, such as complex businesses, multi-state issues, or large inheritances. Thanks for watching. If this video helped you, please like, share, and subscribe. Leave your questions in the comments so we can address them in future videos. See you next time.